Thank you, everyone. Thank you, everyone, for joining today. As a little bit of housekeeping, you should have a Q&A box where you can enter questions during today's presentation. Geoff and I will monitor those as they come in and attempt to answer as we go. We want this to be as interactive as possible. If we don't get to your question, we'll be sure to follow up with you afterward. Also, we'll be recording today's presentation. We are recording it right now. If you miss part of it for any reason, you'll be able to catch up with what you miss afterward. That should be available soon. Soon after we've finished. With that, let's jump into an overview of the plan for today. We'll do introductions, then Geoff will start our conversation with some strategies for what to do with your company's stock that you've accumulated that doesn't necessarily involve selling the stock. This will include strategies for charity, for gifting to family, and borrowing against the stock. The third point will be the bulk of our conversation today. We'll focus on the question of when you should sell your company's stock and strategies to do that take into consideration taxes and how to minimize that while selling your company's stock. And then we'll finish by tying this into a larger wealth management strategy and conversation about that. With that, let's start with some quick introductions. I'm Chris. I'm a partner here at Merriman, partner advisor here. I'm a certified financial planning professional. I've been at Merriman for 10 years, and I did 5 years of tax work before that. I love digging into these questions that we're going to discuss today. And then on a personal side, I have 2 kids. Sam is my oldest and Evelyn is my youngest. They're eager to start summer break here in a few weeks. We love being here in the Pacific Northwest, and especially in the summers that we're moving into. I will turn it over to Geoff.
Thank you, Chris. My name is Geoff Curran. I'm a partner advisor here at Merriman Wealth Management too. I've been at Merriman for over 8 years and working with families for almost over 14 years. As you can see in the picture and above, I'm a certified public accountant. I'm a chartered financial analyst, which is more like on institutional money management, and then certified financial planner. In the picture, you see my family, my wife, Christina. The child in the arms is George, our youngest, and then Calvin is age 5 down below. And kind of fun fact, I have clients who got me into roasting coffee beans. So I roast coffee beans and provide them to clients and prospective families. And also another fun fact, I write fiction as well too. So kind of, we have to round out our hobbies as we work with families. Great. So I'll kick it off here on ways to make the most of your company stock. So to be clear, this is applicable whether you worked at a company, and I'm going to pick on Microsoft. That's a pretty common one we encounter, but this could be applicable if you work at Amazon, Alphabet, Meta, Tesla, all the above. So if you're an employee, an existing or retired employee, or if you bought these companies, and we all know they've done well, the Magnificent Seven is a common thing we hear. This is very applicable to you, what we're going to talk about today. We also want to mention, there is if you have private company stock, we'd ask that you reach out. A lot of these strategies are available, but we want to talk about it. It does have a little bit different twist if it is not a publicly traded company. So we're going to talk about 3 different ways right off the bat where everybody on the call, if you have company stock that has done well, if you own Microsoft and it's done well over the past couple of years, you have more of it than maybe you have an overweight to it. We're going to talk about strategies of what to do with it and maybe how to minimize or reduce or avoid taxes on it as well. So some optionality you might have. To kick things off, we're going to talk about charitable giving. We've encountered this a lot lately, and there are a lot of times when people give to charity, they do checkbook philanthropy, they give cash. Well, when you have assets, appreciated assets like a stock, so again, we're going to pick on Microsoft, but it's applicable to every company you can think of. We have other options. If you bought it for $50,000, whether that was you got compensation from your employer in the form of stock, you bought into employee stock purchase plan, or you simply just bought the stock on the open market, and you bought it for $50,000, that's your cost basis. It's worth $200,000 now. We can talk about gifting those shares. If we have too much of one company, we can talk about different options. So the first one is, what if we gift shares outright? And that we help clients with it all the time. That's simply, and let me take one step back. In all three of these options, whether you're gifting shares directly to charity, you're using a donor advised fund, which we'll talk about. It's kind of like your private foundation equivalent, or a charitable remainder trust where you get income from it up front and it goes to charity at the end. You avoid capital gains tax on the sale of it. So you bought Microsoft for $50,000, it's worth $200,000. If I use any of the three options here, I'm avoiding paying capital gains tax, which could be up to 23.8% on the federal, and it could be up to 13 or higher on a state level if you're in California or other states, or 7% in Washington if it's over $250,000 in gain. First option, now that we delineated that, first option is we're gifting shares. We have an alma mater, you have your kid's school, it could be a church, gift shares directly. We help facilitate that. It goes off the date received by that organization, the fair market value, and that's your itemized deduction. Donor advised fund, it allows you to put money in now, and you can donate it for the rest of your life. And your children are able to, as successor power controllers of it. So we're able to avoid capital gains, like in the first one, and it goes into it, and we're able to distribute on any timeline you want to, in increments as small as $50. And Schwab, Fidelity, Charitable, we're able to move shares directly over. It's real straightforward. And we're able to, you're able to give to any number of organizations you want to over the rest of your life. We look at that a lot of times as charitable bunching, where we're doing a lot of giving in one year. Let's say you had a very high income year, you made $500,000 at work. Great job. Well, you're in a higher tax bracket. Maybe we want to do a multiple years worth of giving at one time of this Microsoft stock where you have too much of it now. That could be a great option to get more bang for your buck. You could be really getting $1.50 for every dollar you donate or contribute. Charitable remainder trusts are becoming a little bit more popular. This is an option that's interesting to people that they want income from it. They don't want to irrevocably give this away and get nothing back other than an itemized deduction. They are charitably inclined, but during their lifetime, they want to receive some level of income. That is a great option here to consider, and we help clients with it all the time. There are pros and cons with each of these options that you should consider that we could talk about in more detail. The other option is you're able to give, when we're building plans, as Chris will talk about later, in it, a lot of clients have a charitable desire. They say, I want to give $50,000 to charity a year. Okay, that's something we can quantify for multiple years. If they want to give to their family, it could be a down payment, a wedding, it could be a new car for their kids, it could be anything, just transferring wealth. I want to add to help contribute to their Roth IRA. You can give, each of you, if you're married, $18,000 per person. So if you have one child and you're married, you and your spouse can give $18,000 each. That's $36,000 without dipping into your lifetime giving of almost $14 million each of you right now. That's a pretty big deal. One example, one thing here on the kiddie tax, we're not going to have enough time to get into it today, but be aware if you do have a minor or a dependent, if they sell it, they might get hit at your tax rate. But I'll give you an example here. I had a client who was 55 years old. They retired. They worked at Microsoft, and they had highly appreciated stock, actually in Amazon. And they wanted to help out their child, their adult child, who is 25, with their house down payments. These clients are on the healthcare exchange where they get healthcare credits if their income is low enough. It's also difficult, as anybody can relate to on the call, nobody wants to pay taxes on a winner they have in your portfolio. So what we did was they wanted to do that gift to their child. We figured out in the plan they could afford it. They transferred the stock. We helped facilitate it. The child sold it. They did pay capital gains tax, but the client themselves didn't trigger higher income, so they didn't have any healthcare subsidy issues. They were able to transfer the wealth, and they also didn't have the psychological pain of, I had to pay taxes on that gift. something to be aware of there. And there is a gift tax filing for it if you're above these thresholds. That's a longer conversation to get into. The other option we run into a lot is, well, if clients we have large non-retirement accounts and taxable account that has a company stock, it has a lot of different things in it. Well, you can borrow and collateralize against it. Merriman has negotiated rates where you're able to borrow against your portfolio. Remember, this has risk to it. You have to be educated on it, but the purpose of it is that it can create a bridge loan where you can borrow against your portfolio. It's interest only. The interest rate can fluctuate with the Fed funds and off of our negotiated rates, and you can borrow money and then you pay it back, whether you sell things in your portfolio or proceeds from a home sale. A great example, I have a client that is buying a vacation home, a second home in Arizona. They have their current one in California. Most people don't want to have to uproot from the current property until they move into the new one. Well, we're doing a bridge loan. We're leveraging their portfolio for a short time. They're educated on the risk. They're borrowing. They're able to buy the new home outright, and then we sell the old home, and then proceeds come in to pay off that margin debt. It's a great way to avoid selling a lot of stock and paying a lot of capital gains. A lot of people fall into that trap. I need $1 million. I got to come up with it quickly. Real estate's emotional, and they trigger a ton of capital gains. Well, if we know we can pay it off and we have a strategy, we can borrow against it. Once again, that is something to go. We have a full discussion about, and making sure you're aware of the risk.
Thanks, Geoff. So yeah, that was a great overview. And actually, before we go on with some of the next items, just looking at questions, we actually did get one come in. We'll address this a little later, but actually, I think this does tie in a bit with what you shared. And I was just going to get some of your thoughts.
Well, first, we're going to cover this in greater detail, as Chris mentioned. The answer is yes. We take, before we work with anybody, we take all of your existing holdings and we're looking at cost basis. You have to have that to make an informed decision. And it's like a renovation in your kitchen. Nobody should be opening up the walls until you agree on the plan and you're aware of the contingencies with the plan. Hopefully nobody on the call has had a bad renovation, but we want to make sure we measure twice and cut once. So we get all of that information from the custodian, like a Schwab or Fidelity, Vanguard, wherever it comes from. We build out a structured plan, and then we look off of current tax rates, think about the future. We build it into a financial plan, as Chris will talk about in a bit. And then we educate the client to make an informed decision on what makes the most sense for them.
Great. And actually, Geoff, while we're at it, another question just came in that's tied to what you said. How common is it that people borrow on margin to buy homes? I think this might be a good thing to clarify before we move on.
Yeah, good question. So it is for a bridge loan. We think of this like a bridge loan. It is not you buy the home on margin and you'll keep it on margin for 20 years. It is not a replacement for a mortgage. It's typically where we have a client where we have a payoff plan. We're going to sell bonds that can't pay as much. But I would say that it's very common. It's very common because our goal is to provide flexibility, minimize taxes, and protect the overall. And I'd say that it's more common than you think, but typically it requires a non-retirement portfolio and a taxable account of generally over $3 million, because what we want to have is enough, depending on the property you're buying, either we can use it for the down payment or we're buying it outright and then we have a plan to pay it off. But typically we need to have a meaningful non-retirement account balance to be able to borrow. You cannot borrow against a retirement account balance. So it's when we're looking at, if a client says, I have this dream to buy this home in Arizona, we're looking at all the options. And the first one is we sell municipal bonds because they don't pay enough. What margin is at, let's say 6.12% of what we have negotiated right now. Well, municipal bonds won't pay that much. So we sell those first. Because if you don't have a payoff that will equate, it doesn't make sense. So we look at the portfolio, look at what it has a tax obligation, tax consequence, and then what is the expected return. And if those can't get over the margin hurdle rates, then we're going to sell them first, and then we take margin afterward to make the math all work out for the client's benefits. Very
Great.
good
And just
question.
to
I'd encourage reaching out. Yes.
Perfect. Yeah, just to clarify, yeah, with the concentrated stock, the most common scenario I think that you shared is, yeah, we have the company stock. It's gone up in value a lot, and someone wants to buy a house. They're planning to sell another one 2 or 3 months later. They can borrow against the stock, and then when they sell the old house, they use that to pay off the margin loan, rather than selling company stock, realizing a large amount of capital gains for just a short period of time. So that's what you were alluding to.
Absolutely. And one last part, because it's a passionate topic, is that
Mm-hmm.
with concentrated stock, we go through a very rigorous process whenever taking a loan against, if you have all your money in Meta or one of these companies. Chris and I can tell you so many stories we read about for compliance and SEC where people they had all their money in Meta, Facebook, and they borrowed against it. And Meta had a very tough 2022. It went down about 70%. It's recovered after that. But it had a lot of margin calls. So these are things we spend a lot of time on educating and figuring out the plan to make sure that we avoid that margin call.
Perfect. Well, thank you, Geoff. So I appreciate that. That was a great overview of current strategies with current stock. And now shifting, often the biggest question we get is, when should I sell my company stock and how should I do it? And if we could see the future, the decision would be easy. Given that we can't, there are a lot of questions that go into this decision. So how will the stock perform? What are the tax consequences of selling now compared to later? We're going to walk through some of the considerations that come into play and strategies for carrying that out. To start with, how do we even know when we should sell or how much we want to sell? This is going to be very specific to individual needs. A 60-year-old with all investment assets in company stock is likely going to develop a different plan than a 35-year-old with a much smaller percentage of their investments in company stock. And there are a lot of emotions that go into this decision. So let's go through an objective framework for developing this strategy. Step one, figure out your goals. Are you going to need this money soon, or do you have a long time before you need it for anything? Retirement is a clear example here. A younger individual who expects to have a steady stream of income from work for many years can likely afford to maintain more company stock than someone who will need the money to pay for retirement costs soon. Other large goals to consider can include things like a home purchase or college tuition. And then step two, assess your risk. So the first part is figuring out how much risk you need to take. The second step here is determining how much risk are you comfortable taking. Geoff started alluding to it a couple of years ago in 2022. The S&P 500 was down about 18%, and many large, well-known companies like Google, Amazon, they were down 40 or 50% or more for that year. And now, while many of these companies subsequently recovered in value, that was a difficult ride for many investors. For those that had a harder time, it likely makes sense to diversify out of company stock more quickly. And we'll talk about the risks of companies going bankrupt soon. I mean, company stock certainly can go to zero, which is generally not a risk we're dealing with for a diversified allocation. And step three, evaluating tax consequences. So realizing more gains, it's going to result in higher taxes. And there are several factors that can make this a bigger or smaller impact. So for example, stocks held less than a year are generally going to have a higher tax rate than stocks held for more than a year, getting that long-term treatment. Also, are there losses that can offset some of those gains? Or another tax consideration, at lower income levels, long-term capital gains could be taxed at a 0% rate. And then states may have tax considerations. Geoff alluded to Washington as a 7% rate on top of the federal rate on gains when we're above $250,000. And gains may also affect your ability to take tax credits or they may change your health insurance premiums, causing that effective rate on realized gains to be higher than the specific tax bracket in some cases. And now I always like to say, while we want to be tax aware, we also don't want to let the tax tail wag the investment dog, if you will. And this can be a fine line. I mean, a company stock sold for any amount will net more after tax than holding a stock in a company that eventually goes out of business. And then step 4 here, develop a plan. So there's much more to a plan than either sell or don't sell the stock. And fortunately, company stock can offer flexibility and to sell and diversify in many different ways. We'll go over some of them as we work through the presentation here. So what are your goals? Different goals are going to create different strategies for your company stock. Large expenses, so retirement, home purchase, travel, college, or other large purchases would create more incentive to sell the company stock. Geoff alluded earlier to strategies for charity and family members. So for charity, the intention may be to never sell the stock. There are several ways that Geoff talked about to gift the stock directly to charity. And the question may be, what the tax impact is and how to take the most advantage of that. Now, with family members, one decision is if you gift while you are alive, or if you hold on and wait for family members to inherit after your death. And for stock with low cost basis and a lot of gain that would be realized if the stock is sold, holding until death can result in a step up in cost basis. So those gains would just disappear and no one would have to pay taxes on it. However, maybe heirs could use the money now, and maybe they're in a lower income tax bracket. So as with the example Geoff mentioned, they could potentially realize capital gains at a lower tax rate than you would. So creating our plan for the company stock, we'll want to have a good sense of the cost of living. This includes the overall cost of living and healthcare costs. Then we want to figure out the types of additional costs on top of that need to be considered and how soon we're going to need the cash for those. And as we review strategies, for company stock, we'll take a different approach depending on how much of the overall account that stock represents. So again, two individuals who otherwise have the same goals will likely take a very different approach if one person has 100% of their investments in that company stock, whether it's Microsoft, like Geoff alluded to, or anything else in that company stock, and the second person has a much smaller amount, less than 10% in the company stock, with the rest in a diversified allocation. So having a larger percentage in company stocks, it's going to create more urgency to develop a strategy sooner and start working through that. And with concentration in stock, there are many biases that we're affected by as an investor. A company can go defunct. As the slide shows, over 50% of companies in the Fortune 500 in the year 2000 have gone out of business. So these are large, stable companies, and effectively, here we are 24 years later. Effectively, it's a coin flip. And there's a risk of owning individual companies that, again, doesn't necessarily apply to a more diversified allocation. But beyond that risk of going out of business, a larger risk that we often, possibly a larger risk that we see, or something we see even more frequently, is might be a risk of long-term underperformance. So Geoff has used Microsoft stock as an example here, since it's so familiar to us. And if you go back in time, if we think back through it, Microsoft had that huge run up in value during the dot-com boom in the 90s. And that was followed by many years when it was flat or negative. Now, in Microsoft's case, it's since been doing quite well recently. There are many other stocks that underperform and never recover to their prior period of dominance, of significant outperformance. So the company stock may not go to zero. Even so, one challenge is the risk that this type of prolonged underperformance can have if it happens at the wrong time, such as right at the start of retirement. And Geoff will expand, share a few additional thoughts on this.
Can you go back real
quick?
Yeah,
absolutely.
And go back one more slide. So
yeah.
To clarify, this is 50% of the companies either went bankrupt, got acquired, or just ceased to exist.
Sure.
So, were sold off for, pennies on the dollar. So just to be clear on that part, but these are names where I think a lot of bias gets built in, where people in the time when these occurred, there was a moment in time where people thought these were unstoppable businesses, that they employees and investors. So keep that in mind when you're evaluating risk. And then one more time on the next slide.
Sure.
I listened to the biography of Microsoft, where at one point IBM was the leader. They were the largest company. And then we watched what happened after that. It is such an important thing to know that of these periods of decades without return, there's only one on this list that really provided a royal share of returns afterward. And these are names that people know. Majority of companies do not go through that recovery afterward. So let's go to it, because this leads into really this next slide. So this is a complicated picture in front of you, but really what we're looking at when we're planning for retirement or financial planning is we're looking for different distributions. We're looking for expected outcomes for clients, and we're simulating 1,000 different simulations or expected outcomes for clients that include negative to positive, everything in between. When you look at that red dotted line, that vertical on the y-axis red dotted line, that's really telling you at that moment is that that's where where the assets don't go to zero. That's where we have like the kind of the point where you own the market, and then what is to the left of that are outcomes that can occur if you own a company stock, like if you have a concentrated single company stock. To that left of it is where it can go to zero, because a company, as Chris talked about, can go to zero or dramatically underperform. When we look at the green line, that shows an outcomes that are statistically probable, where it's predictable in a financial plan. We're having these expected outcomes that can occur. And then we have on the, when you look at the black going all the way out, it's showing that there can be very outsized outcomes. Like an investor in Microsoft has done far better than S&P 500. So that would be on the far right side. But majority of a lot of companies, as Chris talked about, they were actually on the far left and on the statistical and probability outcomes that we look at in the plan. Once again, this is a complicated chart to look at, but we're trying to get a more reliable set of outcomes. You've hit the jackpot with your stocks that you chose, and that's wonderful. Our goal is to help you turn that once in a lifetime opportunity at wealth and make it lifelong and legacy for legacy planning too. This is where, when we're looking at one of our tools we use Monte Carlo, we use Money Guide Pro to help us stress test a client's portfolio to help them make the right decisions or to guide the decision making. And when we have concentrated stock, where let's say you have $8 million, but 7 million of that is an Apple stock, well, we need to factor that into the plan. Yes, it became a large part of your portfolio because it did so well relative to everything else, but also we don't know what will happen later. And if it falls 50%, that's what this stress testing does. So we're trying to figure out with concentrated stock, and as we build out our plan to diversify, if somebody, in this case, there's a prospective client who wanted to buy their retirement home. And it was a very nice home, but they had a lot of their money in this company stock. And we found that because it was so concentrated in the risk allotted to it, where if Apple fell by 50%, 25, 50, 75%, in the software stress testing it, they would not achieve their goal. It's saying out of 1,000 simulations, only 440 of them do they not run out of money. That's an important thing. So we found even with concentrated stock, if we're able to dial in some of the goals and expectations, we can get to a more healthy outcome. And in this case, it was a lesser cost home. But the point of showing any of this without getting into all the details in a short period of time is we need to, and we do, integrate concentrated stocks as specific portfolio positions, and we stress test them. Because our job is to make sure that your shot at wealth, that it stays lifelong and for generations to come.
Great. Thanks, Geoff. So yeah, we can adjust our goals as we're thinking about it. We can adjust our goals for company stock based on what the stock is being used for. And for money that we're going to need soon, so this is our needs category here, such as retirement or other major goals, we'll likely want to aggressively diversify out of the company stock or find some other strategy for providing protection from a decline. Now, the wants category will want to be diversified, but we can be a little bit more flexible with it. So these are items where we might want to hold off or be willing to hold off on selling company stock if the stock was to significantly decline as we're working through the strategy. And if our goal is gifting or leaving to family or charity, we might never sell that stock. The right option might be to hold on to it with the intention that heirs inherit it with that step up in cost basis and that all the taxable gains just disappear. We've said a few times that we want to be tax aware with stocks, but we also don't want to, as I said earlier, we don't want to let the tax tail wag the investment dog. And I want to call out a few key topics here as we're creating strategy. First, cost basis. So often our company stock will have many different lots that were purchased over years of working for the company. And some shares of stock were purchased for a low price and have a large unrealized gain. Others have much fewer gains. We can identify specific shares we want to sell to determine how much capital gain to realize. And I did see earlier a question come in the Q&A that asked exactly this question. Are we able to take that, put that into a spreadsheet, organize exactly how we want to structure things? And yeah, that is definitely something we can and we do work on with families when analyzing company stock positions. Then we also want to identify what the federal and state tax brackets we're going to fall in. In some cases, long-term capital gains can be taxed at a 0% rate, and we may want to take advantage of that. Other taxable events list things like a home sale, but it might also be the case that in the year of retirement, or if you're taking a sabbatical from work, there may be a much lower income where we would want to realize more capital gains than usual. And then finally, future tax law changes. So these changes are beyond the scope of what we're going to get into today, but some tax rates are scheduled to increase in a few years. And in some cases, it may make sense to do something now while rates may be a little bit lower. And we use several tools with clients to project the tax strategy, either in a single year or over the course of several years. And we can determine if we want to realize capital gains this year and look at different trade-offs that come with that decision. One other strategy when diversifying out of company stock that may have large unrealized gains is to strategically use retirement accounts like a 401k or an IRA to build around that position. Now, for example, if we have a lot of Microsoft stock, to stick with that theme, if we have a lot of Microsoft stock that we're not selling for tax reasons because we have a large unrealized capital gain here, it may not be ideal to then hold an S&P 500 index fund in our retirement accounts. Recently, Microsoft alone was over 7% of the index, and then similar tech funds made up over 30% of the index. So there's going to be significant overlap there in performance. A drop in something that caused Microsoft to drop in value is likely to result in a significant drop in the S&P performance, just because there's so much overlap. And that's what this chart here on the left is showing, where we have this company stock, this Microsoft in this case, whereas we have an IRA, we have company retirement plan, call it a 401k, that has these US large stocks where while diversified, there's going to be overlap with the concentrated company stock that we have. Instead, since there's no tax impact to changing investments in a retirement account, we may want to use this retirement account to invest in small company stocks, international and emerging market stocks, bonds, and other investments that are more likely to perform differently than our concentrated stock and provide the most diversification. And that's what we're illustrating with the chart here on the right. And there's some very specific tax strategies that we'll sometimes use with families that we work with to manage the company stock. So for one, selling stock when vesting. So if you're working for a company that offers restricted stock units, so RSUs or other types of stock options or other equity comp like a stock purchase plan, it's often going to make sense to sell those specific shares immediately when they vest. The tax impact at that point on the sale is minimal, and we can move that cash into a more diversified allocation. And then with our existing stock, we'll look at selling individual shares with the highest basis. So if you've been getting shares over many years, we can sell the shares first that had the highest purchase price, realize the least amount of gains, and strategically work through the stock from there. And then filling up, planning annual sales to fill up tax brackets. We may target a tax bracket. Say we have $150,000 of gains that we can realize to get to the top of the 15% capital gains tax bracket. Or we may use state tax brackets like Washington's $250,000 limit, where the 7% capital gains tax kicks in. Now, sometimes we actually have a little more control here. We can make adjustments in other ways to give a little more space. So I had another family, another individual at Microsoft employee, where we increased his tax deductible 401k contributions, and that lowered, in this case, their taxable income and let them realize more capital gains at lower rates. And we were then able to use some of that cash from the sales to make up for the extra 401k contributions, help their cash flow, and get diversified at a faster rate. So there's several effective strategies that we'll work through. And then the last one here involves using options to potentially limit the downside loss of a stock. And there are risks that you're also possibly limiting the benefit if the stock does well, and you could end up being forced to realize some additional capital gains. Now the collar strategy listed here, I mean, it's only to be done if considered carefully, but in the right circumstance, it is definitely worth considering. And I'll shift it back over to Geoff, who'll share a little bit more with us about historical tax rates.
Wonderful. All right, taxes. Well, while it might not feel this way, the current tax rates are lower. They're at a historical low, pretty much. When you look at the current screen, I know it's a lot on here, going back to 1910 till now, the top red is like the top of the marginal tax bracket for income. So that gets you up to 37% right now. The lowest level, the blue, is getting you at the lowest level of the tax rates at 10%. So on ordinary income, it's 10 to 37. Long-term capital gains, qualified dividends, those are at a different rate at advantaged rates. But we're at historical lows. Keep that in mind. You know, things could change, or they're expected to change after the sunset of the current tax regime right now at the end of 2025. So we are in the next 2 years at a historical low tax rates, and that's a known fact. A lot of people talk to us about the budget deficits or the government debt. Well, one way to deal with that is increasing tax rates. So that's something to keep in mind over the next 2 years specifically. Do not let the tax tail wag the dog. Keep that in mind. The other one that we encounter a lot when you have concentrated stocks, whether somebody might have $1 million in Microsoft or however much it might be, a commonly sold option or talked about is called an exchange fund. And what it is where you are, and the way that you interpret it until you look in all the details are, I have $1 million of Amazon stock. My cost basis is 100,000. I have a $900,000 capital gain. I don't want to pay taxes on it, but I now hear what these Merriman people are talking about with diversification. I want to diversify. Well, these exchange funds are talked about where you are putting in your Amazon stock, and they're putting it in, and then other people that have different types of stock, different companies like Coca-Cola, Procter & Gamble, they're putting in their stock. And then at the end of it, at the end of 7 years, and they can have different terms, they're different ingredients, and you're paying a fee throughout it. The way that it's sold is that I will, in return, I'll have my same cost basis. I'll still have 100,000 a cost basis, so the tax bill doesn't go away, but I'll own a little bit of all these different companies, and I'll be diversified. Well, here are the things that maybe aren't talked about with it. One is that a lot of people have Microsoft, Amazon, and all these companies that are the high flyers. So they might not accept your shares. So that's one thing, because they have to be able to have some level of diversification. The other part is that you are locked up for a long time period. It is illiquid. You can't take the money back, and if you can, there are very large penalties associated with it. There is a real estate component for the tax laws to work that needs to be considered. The important thing that is never talked about is that there are scenarios where at the end, the whole exchange fund is redeemed and everybody does get their proportion of it. But a lot of times when people redeem, they trade in their one stock and they might get 4 stocks back, not 100, not 50. They might get 4 stocks back, and they might be terrible stocks. And at that moment, you got to pay the taxes on it, because you don't want to own Procter and Gamble. Maybe, Procter and Gamble might be one of the companies you get out of it. That's a great company, but it's maybe different than it's not. The outcome may be different than the way it is sold to you. So please ask a lot of questions. We spend a lot of time on it to understand all of the different outcomes that can occur. It's important to know, we're wealth advisors. We're a wealth management firm. And while investment management is core to what we do, we manage assets for clients. We're wealth advisors. We're wealth managers. So that includes cash flow planning. It includes tax planning, insurance planning, estate planning, charitable gift planning. Those are just starting points. So when you build out a plan, we figure out how much you can afford to give to charity or give to your children. That's round one. We figure out how much you can do with the current assets and stress testing to achieve your goals and not run out of money. It's one thing most people have in common is they don't want to run out of money and they want to stay financially independent. We figure out how much you can afford to give to your family or to charity. Then from there, we figure out which assets. Then from there, we figure out the whole conversation. Do you give it in trust? Do you give it outright to your children? Then from there, we figure out, well, what kind of conversation should you have? Do you want to role play that conversation? Should it be one-time gift or multi-year gift? So wealth planning is a whole lot more than just saying, what is the expected return of Microsoft stock and what is the tax situation if I sell it? That's something we want to set the expectation of entering a conversation with a wealth advisor. These are the things that we're going to spend time talking about, and we need you to open up about too to get the value from it. We have a process after doing this for 41 years. I have not, but our firm has been in business for over 41 years. We have a discovery meeting where we get to know you. It isn't necessarily all financially minded, but we collect all your documents. We'd like, if you're married, to have your spouse there. In the strategy meeting, if your spouse is not involved in everything, that would be the meeting they should be at a minimum. Strategy meeting is where we heard everything in your discovery meeting. We have version 1 of the renovation for your home, and we want to present it to you and collaborate and figure out the financial plan, the overview of all the financial planning recommendations, how to invest your portfolio and your wealth. You get an idea of exactly what you're paying and what you're paying for. And then implementation meeting is where we want you to have at a minimum, I'm joking, but 10 questions at least. We want you to be curious. Those are the best clients, are curious and trying to find value. And that meeting is about you. We've done the work. we presented to you, gave you a copy of it. We want you to ask questions, and we want to give you an opportunity to walk in the shoes of a client. And if it makes sense to build a partnership, we make a turnkey. If not, we want to make sure you walk away more well-informed than before, and you know who to call. And then we have regular meetings with clients as time goes on. We have professionals we can bring in that don't work at Merriman, that are unique to your situation and your needs. And then we have meetings that go on for the rest of our relationship for generations to come. We encourage, while we can book out more time, at a minimum, we recommend a 15-minute introductory call to kind of assess your situation. Answer most people on the call, they have a couple of the elephant in the room questions. We want to start to assess and help you with them, and then figure out, would you benefit from a full plan, and build that out for you. So we have the contact information here. We have our website to book a meeting, and then we have Chris and my direct email addresses too, and to ask away on questions. We are here to we want to demonstrate what we can help with, and kind of open up, kind of provide education on what wealth management services are. Okay,
great.
So we did should we go to Q&A now, or?
Yeah, great. Thanks, Geoff. Yeah, I know we've been getting questions in, and we addressed a few of them. But yeah, I'm wondering, do you want to read some out to address a few of them that maybe we didn't come across?
Absolutely, and please start to type them in. We kind of had a dry spell of no questions asked for about 10 minutes. Please start adding them back in. We're going to be here to answer them. And then at the end, I'm going to share a story about a prospect on their Tesla stock, and their kind of the bias is built into it. Okay, and before we jump in here too, on this 15-minute conversation, what Chris and I say first when a client has had concentrated stock that has done very well, we start with congratulations. Congratulations. You have your shot at wealth. You have your wealth. And then we start to move on from there. But we always start with acknowledging your positive outcome if it is a positive outcome. So we want to make that a fun thing. Let's start with the question here. It's back to the margin loan. For the margin loan to buy home strategy, does Merriman help secure the home loan? First question. Do you have any tie-ups with any banks that lend? Second question. Since we are getting a margin loan, most banks may not want to lend anyways? Question mark. Chris, do you want to tackle that, or do you want me to?
Yeah. I know you were starting to reply, so why don't you jump in with that, Geoff, and I may add a little bit.
So as wealth advisors, we absolutely help on securing the home loan. Merriman is not a home loan company. We work with outside professionals. We build out your case, but really what you're looking at is we need to educate. It's called a cash out refinance. If you buy a home on margin, and then we need to do, and if you live in California where they have closing dates of 10 days or 15 days where you can't get your mortgage approved in time, and I have another comment there too. But in this case, we buy it with margin. Remember, we're going to have a lot more discussion, so you're educated on it. It's called a cash out refinance. If we deal with it later, where you're doing a cash out refinance, it's a little bit higher interest rates because you're doing a cash out refinance rather than original home loan purchase loan. But that would be months into it. That would be the option there. And you need to make sure, and we help coordinate with mortgage brokers that understand how margin works. Because not all people understand what margin is. They more think of all the movies and how margin is used to take more and more risk on stocks. There's a different discussion here. And we help facilitate it, go through the process, help with sharing documents. We're given approval by the client, and help throughout the process and get the refinance and getting the payoff to pay down the margin loan. The other detail we'll add, there's a fun tip. If you are, let's say you're in California or any state, but they tell you got to close in 15 days to be a competitive buyer. And that's unfortunate how that is the new reality in many cases. Well, you can't get your mortgage, a regular mortgage, approved, but they have what is called delayed financing. So we work with the mortgage broker that we pre-identify, and we start a process called delayed financing. And it's how to deal with this situation. And you're able to get mortgage rates as if you had bought on as a primary mortgage when you initially bought the home. So delayed financing is the option we look at, and we use it to pay off the margin immediately after it's paid out. So we do help with that. Merriman does not have any financial tie-ups. We have the whole market. We have 1,000 to 2,000 options available. We obviously have experts that we think are really talented, brokers that have their pool available to work with. So we have those references, but we are not tied down financially to any providers. We have the open range to get the best solution for our clients. Last part, oh yeah, go for it.
Go ahead. I was going to shift topics just a little bit, so go ahead and take the last part.
Sorry, we're passionate about this. Some banks may not want to lend a cash out refinance to it because they don't understand it. That is why you need to work with a wealth advisor that can educate the mortgage broker properly before you even go down this path. Make sure they understand how margin works. Make sure and that their underwriters will approve it. So that just quick feedback there. That is very important. We've done it many times, but it does require education to the mortgage broker, selecting the correct mortgage broker for that. Not every Bank of America mortgage broker might be able to help with that.
Perfect. Thank you, Geoff. So slightly different topic from the mortgage, but you were talking about gifting. We were talking about gifting and estate tax planning earlier, and question about wanting to minimize potential estate tax, and how gifting can help with that, but also kind of considering juggling that with a potential step up in cost basis. If people are thinking through kind of these trade-offs, what kind of guidance do we have or work with clients on those types of on that minimizing estate tax question?
That's an excellent question. So in America, in the United States, in our tax regime, our current tax policy, you get the step up in basis where gains go away, rental property depreciation, all of that goes away. There's a lot of idle capital out there because of that. The thing is that people live a long time. So we need to think about the investment outcome. If somebody's 60 and they want to hold on to this for a step up one day, or 70, well, a lot can go wrong in 10 years where it didn't make sense to do. But we are in the state of Washington, you're able to gift an unlimited amount. There's no gift tax. There's an estate tax in the state of Washington, but there's no gift tax. So we are able to, depending on the state, avoid state estate tax by gifting out of it and evaluating what that estate tax is to make sure it makes sense. But moving assets out of your estate is a great way to do it, because we also hope over the next 10, 20, 30 years of your life that assets are going to grow. And wouldn't you rather it grow under your children or grandchildren so that they have access to it rather than under your nest egg? That isn't necessarily you're overfunded. You have financial immortality where you have more than you need for your lifetimes. So that is, Chris, do you have anything to add to that?
Yeah, I mean, I think you're exactly right, and I think Washington is a fascinating example where we'll often do that comparison and say, like, okay, do we want to, like, we can gift the stock and get it out of the estate and minimize the estate tax, and kids, if they sell the stock, let's say they're in a 15% bracket, 15% capital gains bracket for that long-term capital gains, so they don't get the step up in cost basis. But it is subject to the state estate tax, which is between 10 and 20%. So in some cases at the state level, it's a little bit of a wash. And so, yeah, to your point, it's like there is the question of, do we want to have this tied up given the longevity that many people have? Is it appropriate to have it tied up for that long? And then at the federal level, yeah, we're talking right now we're talking $14 million per person for the estate tax exemption. So certainly, for many families, even when company stock has done really well, they have quite a ways before, before they need to factor that in. But oftentimes, yeah, selling or gifting stock to family members so they can sell it is more effective than trying to hold it for what may turn out to be 30 or more years for a benefit that may or may not even be there by that point.
There's something psychological about not having to pay the tax on your gain in a position, and your children, they can make decisions. Their family or whoever you donate to, they can make decisions on what to do. But it is there are a lot of impacts on IRMA surcharges. There are a lot of reasons why it can make sense to gift appreciated assets even. Or other assets in your portfolio, and we help you kind of think through every decision has a current income tax situation, charitable giving side to it, and then also from an inheritance level. So every decision is made. There are three different levers that are thought about or pulled during those discussions.
Yep. And I think, Geoff, I have one other thing, because I know we're coming up on the hour. One other thing I was going to throw in, and then I know you had a story that you were going to share that I think might be helpful. But just as an example of, we started the conversation, but even with an hour conversation today, in many ways we're just scratching the surface. We talked about gifting. Geoff, you mentioned annual gifting limits of about 18,000 per year. But I know when we're talking about supporting family members, there are a number of ways around or beyond that. For example, if we're gifting, for kids or grandkids, if we're gifting for education costs, gifting directly to the university, or gifting to help with medical costs, those don't have those annual gifting limit restrictions where I know, Geoff, we've talked before, you've worked with families to find very, very personalized or specific ways to them to gift that works in their case, but may not for others.
Excellent. There's one question we didn't get to, but there's a complex answer to it. It said, do you come across a strategy where you arbitrage the margin loan interest against a property that you buy that appreciates as well as a stock that is appreciating? Can Merriman help with that? The answer is absolutely. We have multiple ways we go through that. There are also some tax rules. If it's a rental property, that maybe we can deduct that interest on the margin loan. We want to go through from a risk level, a tax level, and kind of as it integrates into a financial plan and what that property actually is. Is it a rental property? Is it a vacation home? And is it your primary home? Or is it for a family member? We want to go through that part. We would encourage you to reach out to go through and build those scenarios out. And we want to go through the risk of all of that too. Because debt is a risk, and we want to make sure that people are very well educated about it. One story, and then we'll wrap it up here. We were meeting with a prospective client that owned Tesla stock and did incredibly well with it, and it made a fortune, like a lot of people, on buying some of these stocks that have done well in the Magnificent Seven. And it had come down from their all-time high. As you know, it's down year to date pretty significantly. And we said, we would recommend you sell part of this. We would recommend, because you need to, if you want to achieve your goals, you have too much tied up and there's too much risk. And we talked about the taxes and all of it. And they're like, I need to lock in this inheritance for my kids. I got to make sure it's there. And I needed to get back to this number. And the question we asked afterward that elicited a very interesting response was, well, what if you passed away and your kids received this? Tax discussion set aside, do you think that they would have want to own Tesla? And they said, hell no, that stock is way too risky. So these are things that we want to make sure we talk about and figure out, do we own it for the right reasons? And what are the overall implications of everything in your portfolio? Because you will need money in your lifetime to achieve your financial goals, and risk is real.
Great. Well, thank you. Thank you, Geoff. Yeah, as you said, as you're saying, with that, I think that brings us to the end. So we really appreciate everyone for joining today. As we stated, we appreciate getting to work through some questions. If this inspires other questions after the fact, please send us a message. We love having these conversations. We're happy to discuss further.
Excellent. Thank you,
All
guys.
right, thanks a lot.